Hello, everyone. Welcome to MSS Mentorship and Online Classes. I am Mohamed Sheikh Sise, your tutor and your mentor. Today, we are going to continue IFRS 15, the revenue from contract with customers. For the previous two lectures, we have covered the fundamental as well as the 5 stages for revenue recognition according to IFRS 15. So today, we are going to expand on the fifth stage, the recognition of revenue. But specifically, we are going to look at how we can recognize the revenue over a period of time. We are not going to talk about anything on the recognition of revenue at a particular point in time, as we have already covered that particular aspect. So today, we are going to expand on how we can recognize revenue over a period of time. For example, Company X is a construction company and it has an agreement with the customer to construct a 5-story building, for example. Now, the duration of the construction process, let's assume it will take 5 years. So, as an accountant, you need to know how the revenue that will be generated from the customer needs to be recognized in the financial statement. Whether we are going to recognize the full revenue on the contract inception or whether we are going to recognize revenue based on the percentage of completion or whether we are going to recognize revenue at the date the actual cash is received from the customer. So we need to start thinking about how are we going to recognize and at what particular point in time we are going to recognize revenue, whether we are going to recognize revenue in year one or at this contract inception or year two or year three, or whether we are going to spread the revenue recognition over the contract life. So all of these concepts will be covered under this particular lecture. So basically, we are going to look at contract cost to be specific. So when we are talking about a contract cost, an asset should be recognized for the incremental cost of obtaining a contract with a customer if the entity expects to recover those costs. So basically, we are going to look at what cost we need to capitalize and what cost we need to expense. Very simple concept. The critical aspect, we are going to look at it in the later section. So now, for costs that we are going to capitalize, we are only going to capitalize the cost if it will result to an incremental to the contract agreement, first condition. And when we are going to look at the second condition, the entity expects to recover it through future revenue. Now we are talking about direct labor, for example, direct material. We're looking about contract specific overheads, or we are looking at cost of designing or customizing goods or services. So now these are categories of costs that we are going to include, that we are going to capitalize as part of the contract cost. Also, we are going to look at the expense aspect, which we are going to expense immediately. So the cost is not incremental. So therefore, we are going to amortize the cost over the year or less, depending on the contract agreement. But don't worry about it, right? So example of this cost are the general and administrative cost, wasted materials or abnormal inefficiency, cost related to satisfied performance obligation. So now for financial reporting F7, any cost incurred to fulfill a contract with a customer, general principle that you need to know, should be expensed to the statement of profit or loss as they are incurred. So now we are going to look at the revenue recognition. This is one of the most important area for this particular lecture today, right? So we are going to look at the criteria, how we can recognize the revenue based on the expected outcome. For instance, based on the example I gave initially, um, the contract is for 5 years. Now, at year two, if the expected outcome of the contract is profitable, for example, at year three, if the expected outcome of the contract is profitable, at year one, if the expected outcome of the contract is profitable, how are we going to recognize revenue at that particular point in time? Also, if the expected outcome is a loss, what are we going to do to recognize our revenue? Then finally, if the expected outcome, at the initial stage of the contract agreement, we can't able to determine whether we are going to make a profit or whether we are going to make a loss on this particular contract. So if there's an uncertainty relating to the outcome of the contract agreement, then it means we need to know how we can recognize revenue. So these are the three conditions that you need to know as a student. And to be specific, for strategic business reporting students, you need to understand these areas because when question is tested, you know, to be specific, question might be asked to explain the accounting treatment. So for you to be able to explain the accounting treatment, you need to aware of these conditions of how we can recognize revenue. So now, if the expected outcome is a profit, revenue should be recognized according to the progress of the contract. Very simple and straightforward. If the expected outcome is a profit, then we need to recognize revenue according to the progress of the contract. So we are going to look at how we can calculate the percentage, the progress percentage of the contract. We are going to look at it. And also we have two approach. We have the inputs and the outputs. Don't worry, we are going to look at it, on our way. The second concept, if the expected outcome is a loss, then we need to do two things. One, the revenue is recognized according to the progress of the contract. Secondly, the whole loss should be recognized immediately by recording a provision and an onerous contract and increase the cost of sales. When we are talking about onerous contract, you can go back to IAS 37 provisions, contingent asset and contingent liability. Onerous contract is basically an expected loss-making contract. So in that particular situation, IAS 37, gives us the condition that we need to make a provision. If you go back to the conceptual framework, we're looking at the definition of a provision, a liability, you can able to justify that, yes, we need to make a provision for expected loss-making contracts. So now, when we are going to make the provision, we are going to debit the cost of sales and we are going to credit provision. So this will be the double entry. The final stage, if the expected outcome or progress is unknown, then therefore we are going to recognize the revenue based on the expected recoverable cost. The cost we have incurred to date, if we can able to recover that particular cost, then we are going to recognize revenue based on the cost incurred and as far as we can recover that cost. So basically, these are the three areas, key important areas that you need to know because when we are going to look at the further aspects, we are going to use this as a benchmark to extrapolate to explain in detail. So now, let's go further so we can able to understand. Now we are going to look at contract revenue and contract cost. We are going to look at the components. What are we going to include in the contract revenue and what are we going to include as a contract cost? Now, when you're talking about contract revenue, the initial amount of revenue agreed in the contract. For instance, the example I made earlier, the contract amount stated, let's say it's $5 million to construct the 5-story within 5 years. This is the contract price, this is the contract revenue that the customer is going to pay to this particular construction company. Alternatively, we have a variable or contingent consideration. A variable consideration in contract work or claims. Now, for example, part of the contract agreement stated that if the building is constructed within 2 years, within 2 years, then we are going to give a bonus of 5% of the revenue to the construction company. This is just an example, right? So now what IFRS 15 is saying is that if the condition is probable, if there is a greater than 50% chance that the construction company will able to achieve the construction process between the conditional period, then it means we need to include that particular, you know, bonus as part of the revenue. Also, if the cost can be measured reliably, for my example, I mentioned about 10% of the revenue. So automatically, 5 million, 10% of it can be measured reliably. So if these two conditions are met, then therefore, if there is a variable consideration, if there is a contingent consideration, when we are talking about variable or contingent, it can be achieved, it cannot be achieved. It is not a must that we are going to pay. We can only pay that particular, the customer can only pay that particular amount if the conditions attached to the contract agreements are met. Then automatically we are going to include this particular bonus or claim as part of our revenue. Very important point that we need to know. Claims are amount that the contractor seeks to reclaim from the customer as a reimbursement for costs incurred, for costs included in the not included in the contract price, which is clear. They may arise due to errors or design or customer cost delay. For example, incentive payment, additional payments made to contractor if performance standards are met, as I was saying. The contract is sufficient advance that it is probable that the performance standards will be met or exceeded. The amount of the incentive can be measured reliably. I've already explained all of these points. So what you need to know, if the condition, if the variable consideration, if the contingent consideration, you need to know that it should be probable, greater than 50% chance that the construction company will meet that particular condition. Secondly, the cost should be measured reliably. These are the two conditions. Other than that, we are not going to include the variable consideration as part of the revenue recognition process. Contract revenue is reduced by any amount of any penalty arising from delay caused by the contractor in the completion of the contract. For example, due to one reason or another, the contractor did not able to meet the stipulated deadline. Then automatically, if there is any penalty, it will be deducted from the contract revenue. It will go as a deduction. So now we are going to look at contract cost. Let's look at the components of contract cost, right? Contract costs comprise of the cost that relates directly to specific contracts, costs that are attributable to contract activity in general, and it can be allocated to contract. Short order costs are specifically chargeable to the customer under the terms of the contract. Talking about labor, we are talking about all material costs to construct the house, to construct the building, all directly related costs should be included as part of the cost of the contract. So we are going to look at example, site labor cost. We are going to look at cost of material, depreciation of plant and machinery used in the construction process, the cost of moving plant from one location to another, any directly related cost in ensuring the fulfillment of the contract agreement should be included as part of the cost of the construction process. So now, we are going to look at costs that may be attributable to contract in general, insurance costing, costs that may be attributable to contract activity in general and can be allocated to specific contracts include insurance, cost of design and technical assistance that are not directly related to a specific contract, construction overhead. So basically, these are the costs that will be included in our calculation. So now we are going to look at illustration just to loosen up. So illustration, the following information related to the construction contract. Contract price, $800,000, cost to date, $320,000. Estimated cost to complete, 280. Estimated stage of completion, 60%. So as of now, 60% has been completed. The contract price is $800,000. The cost to date, the cost that we have incurred to date is 320, and the cost to complete is 218. So the requirement, what amount of revenue, costs, and profit should be recognized in the statement of profit or loss? It's simple. We are going to recognize revenue according to IFRS 15. When revenue is recognized over time, we are going to recognize revenue based on the percentage of progress. So we have completed 60%. So we are going to account for 60% of the revenue. Then also we are going to account for 100% of the cost that we incurred to date. We are going to compare like with like. The $320,000 is the cost to date. Is the cost to date. It means the 60% implementation, this is the cost. Then therefore, out of the total contract price, we need to recognize revenue only on the percentage of completion, the progress of percentage, which is 60%. So the profit is 160. We are going to look at example which we can actually solve. The second part, take the same construct, take the same contract, but now assume that the business is not able to reliably estimate the outcome of the contract. So if we can't reliably estimate the outcome of the contract, it means we are going to look at the stage 3 of the revenue recognition, the third criteria. If revenue cannot be recognized, um, if we can't able to give the expected outcome of the contract, then it means we are going to recognize revenue based on the recoverable cost. So in this situation, believe that all costs incurred will be recoverable from the customer. So the cost incurred to date is what is 320. So we are going to recognize revenue as 320. Why is the cost will be 320? There will be no profit or loss because we don't know the expected outcome. Very simple for now. So now we are going to dive detail into the statement of profit or loss. Now, due to the contract agreement, we might have contract assets or contract liability. Now, if we are talking about contract assets, for example, going back to the definition of an asset, you know, looking at the conceptual framework and going back to the definition of liability, looking at the conceptual framework, the contract agreement might result to a contract asset or a contract liability, depending on the cash amount that is received to date. Very important point. So we are going to understand it further. As well as revenue and expenses, they are likely to be a contract asset or a contract liability. These will depend on the amount recorded in the statement of profit or loss compared to the cash received or cost to date. So very important point. So now we are going to understand whether there is a contract revenue or contract asset or contract liability, looking at the 4 steps. So you need to know the 4 steps. Firstly, we are going to calculate the overall profit. We are looking at the total contract price, then we are going to look at the cost input to date and the cost to complete. So the difference will be a profit or a loss. If the contract price is greater than the total cost, which is a component of the cost to complete and the cost to date, then therefore there will be a profit. Alternatively, if the contract price is less than the cost to complete plus the cost to date, then there will be a loss. So if there is a profit, you are going to recognize revenue over based on the percentage of completion over a period of time. Then if there is a loss, we are going to recognize revenue based on the progress, and also we are going to make a provision where we are going to debit the cost of sales and we are going to credit our provision. Then if the expected outcome is not known, then it means we are going to recognize revenue based on the recoverable cost. Stage 2, we need to determine the progress of the contract completion to date. We have 2 approaches. We have the input approach and we have the output approach. The input approach is looking at the cost that we have incurred to date. We are looking at the contract cost, incurred to date as a percentage of the total expected cost. So the formula will be contract cost incurred to date divided by the total expected cost multiplied by 100 for the input. The output method we are going to look at based on the performance completed to date. This is commonly calculated based on the value of the work certified to date as a percentage of the total contract price. The work certified to date as a percentage of the total contract price. If revenue is earned equally over time, example, providing a monthly payroll service, then revenue will be recognized on a straight line basis over that period of time, which is fine. Where progress cannot be measured, revenue should be recognized only to the extent of the contract cost incurred that will probably be recovered. This is the third criteria. If we can't able to measure the progress, if the expected outcome of the contract is uncertain, then it means we need to recognize revenue based on the cost that we expected to recover. So very simple and very clear point for us to understand. Third step, we are going to look at how we can recognize the transaction in the statement of profit or loss, the revenue and the related cost. So now, for the revenue, we are going to recognize revenue based on the percentage of progress. Then also, let's assume we are going to recognize revenue in the third year. We have recognized year one, year two, and we are going to recognize revenue in year three. So it means when we are going to recognize revenue in year three, we need to deduct the revenue that have already been recognized in year one and year two. These revenues should be excluded from the revenue recognition for year three. If we are going to recognize revenue for year two, we need to exclude the revenue for year one. If we are going to recognize revenue for year four, we need to exclude the revenue for year one, two, and three from the total revenue of for year four. So basically, we need to consider that. Also, same as the cost. The cost of sales, the total cost. So we are going to less the cost that has already been recognized in the previous years, in year one or year two, whichever year we are going to do our statement of profit or loss. Then, very simple. Stage four, at the year end, there will be either a contract asset or a contract liability recorded in the current asset or current liability. If there is a contract asset, current assets. If there is a contract liability, current liability. This will be calculated as shown below. The revenue recognized to date, we are going to look at the revenue recognized to date, then we are going to less amount invoiced to date. We are going to look at the cash payment from the customer. Then therefore, if the amount recognized to date is greater than the amount invoiced, then it's a contract asset. It means we have provided more construction process than the amount we have received. So that is an asset to the construction company. And alternatively, if the customer has invoiced us more than the progress we have completed to date, then it means it is a liability to the construction company because we have not yet completed the work based on the revenue, based on the actual cash that we have received. Note that these figures are cumulative and not annually. We don't have anything to worry about it. So let's look at this simple summary so we can understand the distinction between contract asset and contract liability. For contract asset, work done, cash not yet received. For instance, we have completed 80% of the construction process. We have only received 5% or 10% cash. And based on the contract agreement, let's assume we are going to pay the full amount at the end, or let's say at 90% completion. That's what is stated in the contract agreement. So if we have completed 70%, it means we are not yet complete the 100% of the contract agreement. So there is an asset to the construction company. Alternatively, if we have received cash, then the work has not yet completed, then it means it is a liability to the construction company. It's an obligation to the construction company. So this is the distinction between the contract asset and the contract liability. IFRS 15 is not prescriptive about the presentation of contract asset or contract liability. As an as alternative to the term contract asset, IFRS 15 also allows the term receivable and work in progress to be used, whichever. If revenue exceeds cash received, which is contract asset, this should be included within the trade receivables. Any presenters will need to enable users to identify any contract asset. If the cash received exceeds the revenue to date, which is the contract liability, effectively define the income. So basically, IFRS 15 is telling us that it is not compulsory to recognize the contract asset and contract liability as current asset or current liability. You can treat it under the trade receivable, or you can account for it as a defined income, whichever. But that is not our problem. Our problem is how we can identify the contract asset and the contract liability. This is very much important for strategic business reporting students. When you will be explaining the accounting treatment, you need to reference some of these points because these are the technical points and these are the critical aspects that you need to know, especially when it comes to the presentation. So if a contract is a loss making, there will be a provision recorded to recognize the full loss under the onerous contract IFRS, IES 37. We have covered that. So there's no need for us to worry. So now we are going to look at example one and we are going to look at example two so we can be able to understand better. So now, example one, let me copy example one and very good. Example one, let me go to my, so very good. So basically, we are going to look at example one. Don't mind my handwriting. So now we are going to collect data. On 1st January 2021, the requirement stated that how should this transaction be accounted for in the year ended 31st December 2021. Now, on 1st January 2021, B entered a contract with customer to construct a specialized building for a consideration of 2 million. So this is the contract price, which is $2 million plus a bonus of 0.4. Bonus equals to 0.4 million. So this is the variable consideration. And also, if the building is completed within 18 months, this is the condition. So for us to include the bonus of 0.4 million, the building should be completed in 18 months, within 18 months. Estimated cost to construct the building, the estimated cost equals to 1.5 million. If the contract is terminated by the customer, B can demand payment for the cost incurred to date plus markup termination benefit. So termination cost. It will equals to the cost to date plus 30% markup. Then finally, um, at 31st December, sorry, on 1st January 2021, because of the factor, because of factors outside its control, B was not sure whether the bonus will be achieved. Fine. At 31st December 2021, B had incurred cost. So this is the cost to date. So the cost to date equals to $1 million and was still unsure whether the bonus target will be met. So B measured progress towards the completion based on the cost incurred, which is the input method. At 31st December, B had received cash received or invoice. It's 1 million. So now we are going to solve looking at the five stages. So stage one, we are going to calculate the overall profit or loss. So now we are going to look at the revenue. What is the revenue? Is 2 million. Let's do it in thousand. Then the cost, which is the estimated cost to construct the building, which is will be 1,500. So therefore, our overall profit will be $500, 500,000. So stage two, we are going to calculate the percentage of progress. So based on the question, we should calculate it using the cost to date. So we are going to use the input, which is the cost to date divide by the total cost multiplied by 100. So therefore, it will give us the cost 1 million divided by 1.5 times 100. Right? It's 1 million. Yes, incurred cost to date 1 million. So the answer will be, let me use my calculator. It will be 1 divided by 1.5, which is equals to 66.67%. 66.67%. Very good. So now we are going to recognize revenue based on this percentage. So now um, so stage three, statement of profit or loss. So revenue, which is 2 million multiplied by 66.7 or 67%, for example, then the total cost will be the 1.5 multiplied by 66.7%, for instance. So therefore, multiply by 2, hit 1, 3, 3, 3, 1.5, 1,500 multiplied by 0.667, for example. So it's the same 1,000. So therefore, it will be 33,333. So simple. So finally, we are going to look at the amount that we are going to recognize in the statement of profit or loss, whether there's a contract asset or contract liability. So stage 4, statement of profit, statement of financial position. The statement of financial position. So now for the statement of financial position, it's simple. We need to look at the revenue to date. So looking at the revenue to date, which is 1,333. So basically, the revenue to date is equals to 1,333. The cash received is equals to 1,000. So therefore, this is a contract asset because the revenue to date is greater than the cash that we have received. So it means the construction company will recognize a contract asset of 333 in the statement of financial position. So basically, this is just to loosen up, right? Also, we have an example too, which is similar. You are going to solve it. Nothing different about example 2. Let me just browse through it to guide you. On 1st January 2021, S entered a contract with customer to construct a specialized building for 10 million. The consideration. S is not able to use the building themselves at any point during the construction. Fine. At 31st December 2021, S had incurred 6 million cost to date. Cost to complete are estimated to be 6 million. The total cost for this will be 12 cost to date and the estimated cost to complete. So therefore, if we're looking at the total cost, it's greater than 10 million. So this is a loss-making contract. It's an expected loss contract. So therefore, we need to ensure we account for the difference as a provision, debit cost of sales, and you are going to credit provision. So basically, this is the only new aspect that you need to include um, as part of your solution. So when we are going to look at the live online session, we are going to solve example 2.